Valencia. Today I got Steve Tampus from Augusta Financial, our trusted lender, on with me. What's up, Steve?
Zachary, what's happening, baby?
What I mean. So today, what I want to get into, I really want to talk about, how COVID and the lockdown or the stay-at-home orders are affecting specifically buyers and the changes that we're seeing in the market. I want to get Steve on here because obviously from a lender perspective, there's been a lot of things that have happened since this all started back in mid-March with lending guidelines and what they're looking for, programs changing, programs leaving the market, things like that. So I thought it'd be nice to have Steve on here and he could speak from his perspective and I could speak from mine. So that being said, let's get into a couple things here that we're going to talk about. First, Steve, what I'd really like, maybe explain the difference between, you're a direct lender. So what's the difference between a direct lender and a broker, somebody who's just brokering a deal out?
So direct lender basically is we basically lend, fund. We lend in our own name. We do everything internal, underwrite, doc drawer. Like we're considered out here mortgage bankers. We're a little bit of a mortgage banker. We do mostly all our stuff internal. A broker is where you package a deal up and you basically underwrite it internally with yourself, and you send that file out. You look for different investors that want to give you either the kind of deal that you're looking for, better pricing in some scenarios, or maybe a product that one bank or direct lender may not carry. So typically, what you'll find the biggest difference on a direct lender is everything is done internal. With Augusta Financial, we do everything here. Our office is out here in off the old road. The third floor is basically everyone from our operations department, our loan originators, our owners here every single day. Risk managers are here.
It's all in-house.
It's all in
processors, everything.
Correct.
And that's important because what we're finding through some of the stuff that's been happening, some of the bad stuff that's happening through COVID is we've had a few deals where the lender was brokering a deal out and some of those got delayed pretty significantly because they're not in-house, right? So the processors, everybody went to go work from home essentially. So these processors and all these people are working from home and we've had some stuff that got delayed pretty bad. Even before COVID was a thing, we were having problems with deals like that,
For sure. And the big banks, like your big banks and your Bank of America's, your Chases, they don't do everything internal. They kind of ship it out. They have processing centers. Right. So some of your big banks, they'll ship stuff out to Arizona and ship stuff out to a different state where everything gets kind of processed there. Then it gets packaged up and gets somewhere else. But with digital, obviously, it makes it a little easier now, and time frames right now during this time, because so many people are working out of the house. We have many of our staff here working out of their homes, but we kind of, maybe the first week we had a little bit of a setback as far as time, but right. I feel like we haven't skipped a beat. We have people that are still here operating because of the size of our building and everyone's spaced out pretty well. But we've been doing a great job. People have been working from home. But yeah, on a brokering deal, it can be tough. In talking with some of the brokers that we work with closely, it is a different transition because everything's done in their name and time frames. Your contingency
and that's important to a buyer because again, let's pretend COVID's not a thing. We're not even dealing with that, but you're going through somebody they're brokering a deal out. They may not even know who they're brokering that deal out to and how their processes work. And as a buyer, you're required to hit certain timelines. Your contingencies are due on a certain day. You've got 17 days to do your inspection, your appraisal. When you get to day 17, if you don't have that appraisal back and prepared to remove, the seller, the listing agent and the seller can issue a notice to perform. And if you aren't prepared to remove that contingency, that's when you can get kicked out of escrow and hopefully not, jeopardizing your deposit, but you could lose the deal. You could lose the house that you want because of somebody's processes that, we're not confident in. And we've seen it happen. That's sad and it sucks, but you're putting a lot of faith. The person doing your loan has a very integral part in obviously the transaction and being able to hit those timelines and, not lose the property.
Sure.
Let's move on to, so how has COVID actually affected loan programs? Like what has changed from that side of it since this all began?
Well, programs changed. They've eliminated a lot of the riskier portfolio loans. So obviously back in late March, the bank statement loans, the verification only loans, your P&L loans, those kind of all went out the window as far as portfolio. And it's just on the secondary side, it was so uncertain and so much stuff was changing. No one wanted to insure those in the event that something happens, or how long this stay home could be in effect, where people are getting furloughs and people are getting laid off. So a lot of those programs had changed. But as far as most of the stuff we do today, since 2008, a lot of stuff has changed. So a lot of it's your typical 30-year loan fix, 20-year loan fix, 15-year loan fix. But when you go on the outside and you look at some of the high balance loans, and Santa Clarita with price points raising higher and higher, you have to get into that jumbo market. Those programs have changed in the sense of what they're looking for credit score wise. So credit score went all the way up to 7, and you saw recently Chase and I believe it was Chase and Wells Fargo moved all their guidelines to, they didn't even want to look at a file if it wasn't under 700. The broker and bankers, because we service different, we still have the flexibility of lower FICO score, but that has changed.
But even that low is raised, right? Because you could do something as low as like a 620 prior to this, and we're like 660, 670. What are we at right now?
660. Yeah. We have some programs we can still go down to 640, but it's affecting pricing pretty dramatically.
Yeah.
And obviously because of risk.
And that mainly hurts the people that were kind of looking prior, right? Because let's say today's the first day you're thinking about buying, and you call, you or whoever you call to get approved, you're only going to know what today is. It's the people that had a 640 in March that were looking, they're the ones that got affected the most. Or, someone like myself, a business owner, I'm not going to get a traditional loan. I'm going to have to go through like a bank statement program or something like that. And if those are pulled out of the market, then, and that's pretty important. I think I have this as another question later, but, if you were pre-approved in February or March and, you haven't talked to your lender since all this began, 100% you need to reach out to your lender to find out, have you been affected? I think we're jumping ahead, or maybe I just put these in the wrong order because it seems like a natural segue to talk about that right now. But, I know we talked about it a little bit earlier, but, if you're dependent on your overtime, or, if your hours got cut back right now, or, God forbid, your salary decreased and they're only paying you at 80% of your previous salary or whatever, obviously talk to your lender immediately. Don't assume you're still approved for the same approval amount you were at prior to this, because it may have very well changed.
Yeah. And I'm glad you touched on that, because, some of these buyers, because they're out looking and they're waiting for the right time, and with so much uncertainty, even with the job market, not knowing if your business is essential, or I just spoke to someone recently and he just got put on furlough like Monday, like yesterday. So we're all the way in May, where most people are going back, kind of thinking they're going back to work in 2 weeks. Right. He actually just got put on. So, and he was in the market shopping, was pre-approved since January. And I asked him a question like, when's the last time you've touched base with your lender, as he had gotten referred over to us and looking for something different. And he said it's been a few weeks. And that I asked him, did the lender know? And he says, well, I'm a salary employee. I'm still employed. If you call and verify, I'm an employee, but I'm on a hiatus, or I'm on, some kind of transition. So I told him, I said, that will directly affect how going forward you can buy, So right. Something that we're seeing, Zach, and I know we're kind of jumping ahead a little bit, is something that we're seeing a lot, and something that we ask questions on is when we pre-qualify someone. Let's say you have an employee that's an hourly wage employee. And a lot of these people, like we had clients that were in the airline industry, and to stay at work, they had to take, they're going now, their full-time schedule is going to be 32 hours instead of 40. So when we pre-approved them back in December or January, we had 40 hours of a work week, plus we had overtime. We had a little bit of overtime, whether it was a few $100s a month or thousands of dollars a month. A lot of that stuff's been taken back. And what they're doing right now, underwriters are doing, is they're making sure, they want to see, is there consistency? Do they still have that same amount of hours that they're currently working? Are they still getting the kind of overtime that we've been averaging out over the last 2 years? Because maybe 2019 was a strong year. They made a ton of money in overtime. So it's just something that if
your debt to income ratio is based off of all the overtime that you worked in 2019, and now maybe you're not getting all that overtime. So obviously that means your income level is down, which then affects your DTI. Just for to explain that, DTI is how much the lender is willing to finance you in terms of a home based on a ratio of how much income you make versus all your debt.
Yeah.
So if you make $10,000 a month and you have no debt, you don't have a car payment, you don't have anything, then it's usually around 41, 42% is what
up to
you can get a loan for. So if you make $10,000 a month, then you're basically getting a house up to around $4,200 a month. Now, if you have a $500 car payment, then subtract that $500. Now you can only get a house for up to $3,700. If you have another $500 car payment, now you can get a house up to $32,000. Blah blah blah. Mm-hmm. So, if you were making $10,000 a month off of that OT, and now you're down to, only $9,000 a month, that $4,100 a month obviously is going to drop in that ratio of to 9,000 now instead of 10.
Correct. And that's,
and those are all things that were happening, obviously the first few weeks when the stay at home and everything happened, those were the worst. Some of these last few weeks have been some of the most stressful for me personally in real estate in my, decade in, because of all that. We had over 20 open escrows as everything happened. And, we had 8 of them in that first week that basically fell apart due to job loss or debt to income ratio changes or minimum FICOs. All these things that we're talking about it was trying and scary and, emotional for our buyers and sellers and people that needed to sell and move out of state, or people that needed to buy because they already sold their home. They don't have a home. We had people in that middle, that weird gray area of they'd already closed on their house and they literally have nowhere to live and they were dependent on finding a home, and then guidelines changed. It's this has been rough. Knock on wood, it feels like we're coming out of it a little bit right now. And finally, because now we know, right? Now we know all these things that you're talking about. Now, when you get a buyer in, we got a better
how to prepare and prep. Yeah.
And hopefully we're coming towards the end, right? Like, the stay-at-home is supposed to be lifted soon, and things should be getting back to a little bit more of normalcy, and people hopefully getting their jobs back here soon, and hopefully we're
a lot of stuff on Friday.
Say that again.
They're opening a lot of stuff on Friday.
Right.
So, but what's going even a little bit further down too is that when you go to close, and obviously we don't know how long.
Ask you that, yeah.
When we go to close, they will do. It's a pretty extensive questionnaire, because we look at a few things. How well, because you got to figure when first payments due, and hopefully with everything opening in the next few weeks, we won't have this issue, people going back to work. And it was kind of surprising when I spoke to this gentleman yesterday, because he just got put on furlough, or he just got put on hiatus. So one of the things they ask is do you have any anticipation of going on some kind of hiatus furlough? And that gets asked at the day of funding. And
right.
It's frustrating. I know with agents, we had 2 transactions last month that clients talking about overtime and payroll, had no idea this was going to happen. Went in on a Thursday, and their payroll structure changed on Monday, and they didn't have the window to say, okay, well, I'm not going to take that. It's either take that or you're going on,
got it,
unemployment kind of thing. So we actually had to explain to the agents, like, hey, the borrower no longer qualifies. Right. And that's a tough conversation. And I know the borrower
the day before. Of course it is. I'm sure it is.
Yeah, and we here at Augusta, we do a lot of business with all the local agents. So it's good that our owner backs us as far as that goes, our president, and he's out there constantly, kind of letting everyone know as well. But it's a tough conversation with the borrower too. Borrowers, hey, I've been here for 17 years. I don't understand. I'm an employee here. Yeah, but stuff has changed. We went off of what was. We can't.
Right.
We only can go off of what's going to be insured, right? So yeah, that's something that we've been kind of taking steps forward on too.
I'm going to backtrack a little here, only because I want to touch on a couple of things that we're seeing on our end as far as the real estate side, and some of the things that have changed for the buyers. It's all we've been very fortunate here in Santa Clarita. You know, LA City actually did shut down showings. You were not allowed to do showings in many parts of Los Angeles. Fortunately, here in Santa Clarita, we're operating off of LA County, not LA City, and they were just going by what the governor had said, which had deemed us essential. So we've been having showings throughout this process. They've changed a little bit. They definitely we're not allowed to do open houses, obviously, just because of large groups. You're having to do one-on-one showings. The listing agents and sellers are requiring a couple things. You pretty much can't even see a property at this point without providing a pre-approval. And I've got a question for you about a pre-approval in a sec, just to explain the difference between a pre-approval and, a pre-qual. But these PEAD, PEAD forms are being required, that every person that's going to enter the property, from me to, let's say, a husband and wife, we all have to sign one and basically say, we are not experiencing any symptoms, fever, coughing, any of that. You haven't come into contact with anybody that had COVID. You're almost having to sign off on every single property you're going to go in before you even get there. So it's kind of even delaying the process. Let's say you called me today, an awesome house popped up and you want to go see it tonight. It's making going and seeing something tonight, that short term, pretty difficult, because we got to get all these forms. You have to have that pre-approval. We can't even see a property without, sometimes they're even requiring the buyer to show their proof of funds for down payment.
Mm-hmm.
And that wasn't normal prior to all this. You would have to have a pre-approval and proof of funds prior to writing an offer. We would submit that with the offer, but we didn't have to show that to get into a property. Having your own masks is going to be important. Assume that you're going to have to show up in a mask. Obviously, that's becoming everywhere anyways, but they're requiring even gloves and booties in some cases. This COVID addendum is an interesting thing. This would be more of a case-by-case thing when we write an offer, but honestly, we don't even have to get into that. If anybody has questions on that, just hit me up. But that's another thing that some people are submitting with offers, and it's protecting you in case you were to actually get COVID somewhere through the process, or kind of like what you were talking about, if you did lose your job 3 days prior to close. So there's some interesting changes going on in our world, but the good news is we still have been able to facilitate transactions here in Santa Clarita. And then, so this kind of goes back to what you were talking about, and this is what I want to ask you, because, we've talked about this for years. Even submitting an offer out here in Santa Clarita, if you submit it with the pre-approval, having DU approval, that means that it's gone through an underwriter. Maybe if you can explain that process a little bit and what the difference is between having that DU approval versus, having a verbal pre-qual from Chase,
Well, having a verbal. So when we go through our application process, as far as my team and I only can speak for my team and and I can speak on experiences that I've had where I'll speak to a client. I ask him, have you been through this process? They'll typically say yes. And I said, how far did you get through? And a lot of times they'll say, we did the application. And I said, how much information did you send over? And in some cases, they'll just send an updated pay stub. They won't send like full tax returns or W-2s. And, with work nowadays, and I just really kind of go into like purchase price points. So with purchase price points of where they're at, obviously the borrowers are making decent money. So, and the way they make money is not always typical. It's not just a commission. It's not just a salary employee. So the DU process, what's nice about a DU approval is you can see the scope of how they're underwriting the file. You can see what their ratios look like. You can see if the ratios are stretched a little bit. You can see what kind of income they're breaking down. So it gives you the ability as a real estate professional to say, hey, I'm looking at 3 offers. This guy's self-employed, or this guy's in a business, especially today. This guy's in a business that, there could be some questions 2-3 weeks down the road. Right. Whereas, even if you were to, and I think you and I worked on a file that you had me look at an approval, and it was completely different than how they submitted. We see that a lot. And it gives us an identifier of how they're looking at the file and how they're going to underwrite the file going forward. So if you see a DU approval, let's just say buyer's buying a $500,000 house, they're putting 25% down. You got proof of assets. You know where the assets are coming from because it shows. It's not a gift. It actually shows where the assets are coming from. And then you can see what their credit scores are. You see what their debt ratios are. The debt ratios are, maybe it's 12 over 32. The debt ratios are real low. And then you get another borrower, borrower's getting a gift for 100% of the down payment. Credit scores are great, but your ratios are pushed. Your front end ratio is at 44, your back end ratio is at 48. So you're obviously, because of the credit score, you can get extenuating circumstances and getting a little bit of a push for debt to income. So you could have issues. God forbid he loses 8 hours of work week. It could change. So
it means they may not qualify for the property anymore. Correct. And that's what when we're submitting, from the perspective of a buyer's agent and submitting an offer, we want to show our strength. So we want to submit that with the buyer pre-approval, that DU approval, send it to the listing agent and saying, look how solid my buyer is. Because, even during the pandemic, it's competitive out there. Yeah. There's still multiple offers. Things are still moving pretty quickly. The good stuff, the turnkey stuff, we're still seeing multiple. We listed 3 properties, not this last week, but the week prior. Everything had multiple offers within 72 hours.
It's crazy.
So you're getting, from a listing agent side, then we want to vet all of those multiple offers. We have 3 or 4 offers. Which one is the most stable, and that's what we want to present, that strong offer when we send. And, in respects to like why I brought up Chase is sometimes, we've been in these transactions with somebody who has a pre-approval from Chase, and we've been mid escrow to come and find out this person isn't qualified. That's happened with some of these big banks because they did more of a verbal. Oh, how much money do you make? Oh, 150,000. Cool. You could buy anything you want,
We see a lot of that with the online, like when they apply online. They don't go through
they're not vetted.
Thorough. Yeah, they're not thorough. I mean, one of the things, when
and that sucks for the buyer. I'll just say that. Imagine thinking you're pre-approved for this $700,000 house. You get 3 weeks into escrow. Maybe you even removed your contingencies, and you find out that your ratios are screwed up, and you actually don't qualify because you didn't provide I don't know, your student loan debt or something that the bank wasn't taking into, they weren't accounting for that, and it just screwed up your ratios. You actually don't qualify for the house, and you lose your dream home because the lender didn't do a good job. We've literally seen that happen. That is an unfortunate situation for a buyer. And even worse, if it ends up costing you your deposit money. Imagine if that screwed you and cost you $15,000 in deposit money. The seller isn't going to care that your lender sucked and didn't do a good job. They're going to go after that deposit money.
For sure. Because there's other sides on that purchase spectrum. So they're at risk too, the sellers, right?
Right.
So I mean, what we've tried to do here, and my team and I is we try to do a full, and I know sometimes with the borrowers they get a little frustrated because we do ask for so much information up front, but we kind of explain to them, and hey, when you do put an offer, we want to put our 2 feet forward and our best foot forward. So we're going to get as much information so that when we send the file, like for instance to you, or an approval, that all we need is a contract and we're ready to rock and roll and we're ready to close. We're not going to have any questions going forward. And with Santa Clarita, even in itself being somewhat of a smaller town, and everyone kind of knows everyone, the reputation of the lender and what's coming forward is huge, right? I mean, even with you, when you're a listing agent, one of the top listing agents out there, you see all these homes and you see all these buyers. When you get 5 offers, besides just you're looking at the reputation of the person that pre-approved it.
Oh, it matters for sure. Having a local lender who has a good reputation, having that file come across. Let's say we have 5 offers, and it's you or someone from Augusta. I mean, let's take you out since you're the guy that we tend to work with the most. Let's take you out of it. But let's say we see another reputable lender in Santa Clarita that carries a lot more weight than having a Chase or Wells Fargo, or even somebody in town who doesn't have a good reputation, because there are people, or some of these, when they're brokering a deal out, that's not always the best thing. You want to know that you just want to know that someone vetted the process out, everything we just spoke about. You want to know that was getting done, because nobody wants surprises. Just what you were saying, the seller's probably writing an offer on something. Mm-hmm. If this deal falls apart, they risk losing the house that they want to purchase. There's so many layers, and contingencies are a big part of almost every transaction right now too. So you just want to get it right from the beginning, obviously. And sure, the buyer should want to do that too. It would be a really sad, unfortunate situation to get 2 or 3 weeks into a transaction. Let's say you don't even lose your deposit money, but you just lose the property because the lender didn't vet you or run your ratios correctly, or forgot to account for that sucks.
No, it totally sucks. It's funny because I actually, worked with a client last week, and they wanted to go see a property, and we needed to get a full approval, so we had to get a lot of information. And they kind of made a joke and said, "Wow, we need to kind of give you all this information just to see the property." I said, "Well, put yourself on the seller's side. You don't want a bunch of people walking through that are looky-loos right now." Great thing is that when you get fully approved and you go through the full process, if that house is the house that you guys want, then you're ready to go. But yeah, I mean, it's good that we got to inform the buyers as well that be prepared.
And that's a good. Sorry, I just want to speak to what you just said, because, and that's why we tell people, I mean, people all the time, they're like, oh, we're thinking about doing something in a couple months. I would call the lender today. The most important first step is calling you, getting a hold of the lender and getting this all dialed in, because you know what, the second you start thinking about it and you go, oh, it's going to be a couple months, the most perfect house is going to pop up tomorrow. And you're not in a position at this point, we're not even in a position to go see it. Pre-COVID, at least we can go look at it while you're getting your stuff turned into the lender and trying to get that approval. But if those things, we used to be able to get that all done in the matter of a day. If it's taking a couple of days now, that couple of days could cost you the home, because things are still moving that quickly.
Especially with verifications. Verifications are taking a little longer, especially if we're trying to maximize your approval amount. Verifications are
verifications, right?
Correct. Yeah. And we go through the full process. So there's no, kind of like what you said, there's no surprises. I'll tell you another thing too, is that when you're a buyer, if you're a buyer and you're out there and you're looking, and there could be some changes in what your income is going to look like, man, be upfront. Just tell them. Most of the time, us as lenders, we want to help, and we're pretty good and we're pretty resourceful if everything's put in front of us. You know what I'm saying? It's when you don't share something and then we catch it 2 weeks in, and it happens. As much as little things happen, but if everything's kind of divulged up front and it gives us the opportunity to make adjustments and have to pivot if we have to, then we can do it.
Well, I think that's why it's so important for the buyer to not only have a good trusted realtor, but have a good trusted lender and be open and honest and upfront. That's the only way you're going to get through the process unscathed. It is surprising sometimes that people want to keep stuff close to the vest or not share certain things, but they're going to get found out. And if it's going to hurt you down the road, why wouldn't you just be? Because oftentimes we can strategize around those things. I think that's why we like you so much, is you're really good at, there's always a path A, a path B, and a path C. But you got to have all the information to be able to walk down whichever path makes most sense. If you think you're on path A and a curveball comes at us, 2 weeks into the transaction, now you're scrambling to get down a path B or C, if there is one. So 100%. I think being open and honest up front is important.
And you guys do a great job, obviously, of when you meet with a buyer and letting them know. But, I would just say, one of the first things I always tell them is that, when I go in, because, when you talk to a borrower, they'll say, well, when you ask that, I said, just put it all out in front of me. Let me take all the information in, and then let me see how I can structure. And I'll give you a few options of how we can move forward. But yeah, definitely.
So the last thing I had, I think we got through all of these, which is cool. I know we were talking, I want to bring this into this too, because, when all this went down, a lot of people heard about forbearance and were excited for it, right? The possibility of not making a payment for 3 months during all this sounded appealing. And, if you lost your job and you had to go through forbearance, I mean, obviously, if that's the only scenario that's going to save you, then you got to. But what I want to talk about is, let's say you do still have your job and you are essential and you're working through this, it probably is not a good idea to go through forbearance if you can avoid it. And I think you ran into something, I think we both ran into a couple of things over the last week that no one was really prepared for. So maybe if you want to speak a little to what your scenario was.
Perfect. So forbearance. And I think when the stimulus package kind of came out, everyone started talking about, hey, we're going to be able to defer payments. And obviously if you're in that position and if you did have to lose your job and you are on hiatus and you're not making income, by all means, it's out there to take advantage of. I think the forbearance thing is a great thing because it's not affecting your lates on mortgage. It's not going to appear on your mortgage as a mortgage late. So I think I sent you over what it looks like on a credit report, and it's just kind of populating now, because if you applied for it late March, or if you applied for it in April, the bureaus are just kind of updating now. And if you look at this trade line here, we had a borrower with a very good credit score who never been late on his mortgage, 32 payments, never been late one time. And we ran the transaction. We saw it on there, and this is how quickly stuff changes. So as long as, from what we understood, is as long as he made payment, he would still be eligible for a new loan. Still currently working, makes good money. But when he called in to make his payment, the servicer offered a forbearance and said, hey, would you like to take basically 3 months off of payments? And he's like, oh, well, what does this mean? Well, you're available to do a forbearance. You can skip the next 3 to 4 months of payments, and then you just have to make those payments up. So at the end, there's a lot of different servicers telling different stories. So typically what a forbearance would be is that after the 3-month period that you had the forbearance and you didn't have to pay, it's not a deferment. It doesn't get, some people think it's a deferment. It's going to get put to the end of the loan. It's not how it's going to happen. What happens is
they think they're going to add 3 more months on to their 30-year loan.
And so it's like not a big deal. Like, okay, cool, I don't have to make payments. But no, that's not what happens. What happens is you have to make up the payments that you've missed and that current payment. So on month 4, for instance, on day 120, you got to make up 4 months of payments. Right. So the servicer went ahead and said, well, if that doesn't happen, if you don't have that money, we'll modify, is the word they used. We'll modify your terms. So, I was in that 2008 through 2012 window when people had to modify, and as much as they offered modifications, to do a modification, you had to be late on the mortgage. So that was, we don't obviously know everything. Everything's kind of changing with the forbearance because it came out.
It's happening in real time right now.
Real time, real fast. What we do know is, and what we know as of now, is that if you have applied for a forbearance, and you have, even if you go back and make your payment, if you applied, you cannot do a Fannie or Freddie insured loan for the next 12 months. Right. So, if everything hearing about interest rates are going to be coming down, interest rates are going to be getting
Let me just explain that real quick, because you're saying even applied, meaning you haven't even actually gone into the process. If you've applied for it with your bank, it's going to affect you. It's going to pop up on your credit, and it's going to stop you from being able to refi, or if you were going to, sell and buy, purchase, you're not going to be able to do either of those for 12 months.
Correct. So it's applied and approved, as long as the bank approved it. But right now, from what I understand, the bank's not asking for a lot of information to approve it. There's no guideline of what you can or cannot show. The borrower that I'm showing you here still is currently working, not having a problem making payment. He just thought, hey, I can kind of game the system.
I'll take advantage of the situation. It would be great to not have a payment for a couple of months.
Correct. And something that we're hearing on the credit market side is that, because if you could just put yourself in the shoes of a creditor, if you see deferred car payments and you see a few credit cards that are deferred, and you see now a mortgage deferred, and maybe you're on hiatus or you're no longer employed, what we've been hearing is that credit lines will be cut back, if not closed. And it's crazy to think, because I still we talk to people, we talk to numerous people every single day on applications, and they'll think about maybe buying a car, and we'll talk about forbearance with them, and we try to explain to them about forbearance, and they're like, well, the servicer said, and unfortunately we don't have all the information, but we do know a few things about it, that it's going to affect your credit this way. When someone's looking at your credit and they see 2 or 3 things being deferred because of you're not supposedly employed, how can they lend you credit? Right. And they don't want to fall into that window of what happened in 2008, where they said, hey, just run everything through credit, and then if stuff doesn't get better, BK it all. Right. So
that's what the creditors are looking at. That's what you're saying is if you've gone through forbearance, so you go to get a new car, that's going to pop up, and they're going to go, nope. And I think we both heard a story of even, someone getting their credit card shut down. These are all happening like real time right now. And, so the point of the story is, if you are okay and you're working and you can avoid forbearance, don't go through it. It's going to screw you financially. It's going to screw your credit one way or the other, whether that's for 12 months or if in a couple of months they come out and there's some sort of, relief for it or whatever. But as of right now, it's going to affect credit, and it's
going to affect your opportunity moving forward. And,
right, because
we both believe there's going to be
3 months of rates drop to 2-something%. You're not going to be able to refi now.
Correct.
Yeah.
Correct. And it's from the time. So let's say you get a forbearance, and I had a long talk with a client, same scenario last night, and he says it would help out tremendously. We can easily pay it, but it'll help out because I could do this A, B, C, D, right? So I said, look, you go in forbearance. They gave you 4 months. So that's 4 months. That puts you all the way through September. Then you come back in October, make your payment plus the 4 months. He's like, yeah, I have the 4 months in savings. Perfect. You pay the 4 months. Now that gives you from October. Now you're current, right? That's not if you didn't modify. Now you're current. It's 12 months from October that you can do anything with a mortgage.
Yep.
So, I mean,
and maybe and even like you said, maybe even buying a car, because right now there's a lot of good opportunities out there. There's going to be opportunities out of this. I mean, we're already seeing 0% for 84 months.
Nice.
Yeah. If you need a new car,
for 6 months. I mean, it's funny because I was speaking to another client, actually a family friend, and they were telling me they're going to go buy a car because they don't have to make payments for 4 months. And I said, God forbid you ever try to get out of that car early. And they're like, what do you mean? I said, well, it's a 36-month lease, so it's basically going to turn into a 40-month lease. If you try to get out of that car early, you're going to be totally upside down.
Because you haven't paid anything down.
You haven't put anything down. Yeah. So I mean, definitely that could affect you down the road. Now, look, this is out there. If you need it, I mean, this is why it's there. I mean, if you need, you're not working, you're not making income, take advantage of it, because it's not going to affect your credit score. But when a creditor is looking over your bureau and they're saying, hey, there's 9 things on deferment and we think you're unemployed, gosh, I don't know if I'm going to approve this guy, right? That's where and that's what we're talking about, is people that are, and forbearance has affected interest rates right now. It's affected pricing. It's affected high balance pricing. Why there's such a difference in high balance pricing is because forbearance. They're seeing, and some of those forms that we were talking about earlier, is very important because, if we close a loan in May, your first payment's not due till July.
Right.
And there is a little bit, if now all of a sudden you don't know if you're going to be employed, right? We're all hoping that the employment will continue, but God forbid that happens, and then you go into like a first payment default, So definitely affects.
Right on, brother. Well, hey man, thanks for hopping on and doing this today. How cool.
Very cool. Very cool.
We'll do
love to be on.
We'll do another one like happy hour time, and we'll get some beers involved.
Yeah, we could do that too. I get the whole office involved. That'll be sweet.
Right on, brother. All right, man. I'll talk to you. I appreciate you. Thanks everyone for watching. If anybody has any questions, wherever you see this, I'll actually attach Steve's info, my info. So if anybody needs anything or has any questions about anything that we talked about today, by all means, please reach out to either of us, and we'd love to help if you have any questions.
Awesome. Great.
All right, brother. I'll
Take
talk
care.
to you. Bye.